Welcome to Kings and Queens Accounts class. Today we will be looking at how to manage expenses and revenues. Every business has the experience with expenses and revenues. Once a business is in operation, there will be the need to deal with their expenses and their revenues. So we're going to be looking at how to manage our revenues and expenses. And to do that, our session today will be guided by, as usual, our objectives. Define expenses and revenues. We also want to know how to treat the expenses and revenues and interpret transactions, and as well to record using double entry principles. So let's dive right into it. The first thing we'd like to do is to define. So we're going to define our expenses. Now, an expense is a cost. Right? Our expense is a cost incurred. A cost incurred in operating the business. So our cost incurred, we acquire these costs because the business is functional. What are those things we refer to as cost? For example, we have to pay salaries because we have workers. We also have to pay, we can also refer to it as wages. We'll have to pay electricity bill, right, or utility. So we may have our light bill. We may pay for water bill. We may also insure the business, and as a result of insuring the business, we may have to pay insurance. As a result of operating the business in its daily activities, you are going to have some papers and other small accessories that will help in the office and clerical activities. So we talk about stationery. The business is, you may also, let us say, have a motor vehicle, and therefore the motor vehicle is being used for the business, so there needs to be repairs or there needs to buy fuel for gas and so on. So we may call it motor expense. There are others that we can bear in mind in relation to the general operation of the business. So we looked at wages, we looked at the utilities, wages and salaries in relation to persons who we have employed to work for us. We have to pay our light bill or water bill. If we have insured the business, then we are going to also have to deal with insurance, stationery, motor expense, and there are a host of others. If, for example, we have rented the building, yes, so we'll pay for rent. Okay, so these are examples of expenses that are incurred or occur as a result of the fact that you are operating the business. All right, let's jump into the revenues now. So revenues are really why the business exists. Yes, so it is the return from goods and services offered to the customer. So you offer these goods, you sell it to the customer, goods or services, so, and you obtain the revenue, that which you get in addition to what you have sold. Yeah, so it's a return, the money you get back as a result from the sale of the business or from any other income streams. For example, you may rent a building, so you have a plaza or a mall and you own the mall, you're operating your business on the mall, and you have also subletted a number of other places on the mall to others. So they would be paying you for rent, and therefore it would be referred to as income, right? All right, so examples, we'll have rent received, right? Now, one of your main income would have been your sales. Yes, your main income or revenue would have come as a result from your sales. But as I said earlier, if you rent your property to somebody in addition, you will receive rent. So it's referred to as rent received, as well as you may discount received. And this is where you have offered to, you have received from your supplier a reduction in the cost of the goods. So let us say that you bought from your supplier goods valuing $1,000. Yes, goods valuing $1,000. And they decide, because you're paying them early, they decide to give you a 10% discount. The 10% of 1,000 would be 100. Brilliant. So therefore, your cost to pay your supplier will not be 1,000, but it will be what? 900. So this 100 is a revenue to you. You are retaining money. All right, you're retaining money, so it's like a revenue to you, additional revenue. You are not spending all of the 1,000. What you're doing is spending 9,000. So you're getting back something, right? That's why it is discount received is referred to as a revenue. It may be as well that you have done some business or you provide some service for your clients and you're charging them a commission. Therefore, you will receive commission. So it is called commission received. All right. So all of that is revenues. Commission received. So your revenues, example, rent received. Yes, your sale, because it is a general, the real reason you're conducting your business. Discount received, commission received. These are examples of revenues. You may get it in other ways. You may invest your money and receive in terms of interest. So for example, if my business lend another company money in the form of debenture, then I will also receive an interest and debenture interest, and that would be income on our money. All right. So now that we have completed objective 1, we can move to look at objective 2. So, how to treat it using the double entry system. You would have heard me say over and over again that there are some basic concepts that must be understood in accounting, and that is assets liability, and capital. Now, asset, liability, and capital, they are treated in the double entry system the same way. All right? Now, assets. So expenses are treated the same way as assets. And revenue is treated the same way as liabilities. All right? So assets are treated the same way as expenses, and revenue is treated the same way as liability. Therefore, if asset account always carry what is called a debit once it is being increased, and the same thing applies to expense. Liability will be credited because and so revenue is always treated the same way. All right, so asset and revenue carry a debit balance. Liability and revenue carries a credit balance, or if they are increasing, you credit. If they are increasing here, you debit. All right, that is very important to get. Assets and expenses are treated the same way. Once they are increasing, the debit, and once liability and revenue are increasing, the credit. They carry credit balance. All right, that is very important, and to get an association between our assets and expenses, liability and revenues. All right. Okay, now that we have established that concept, we can go to objective 3. And that is how to interpret the transactions. Now, I'm going to be moving to prepare some transactions. Bought stationery. Bought stationery by cash. And that amount of money is $400. The second one is pay rent by check. With a total of $10,000. The third, pay advertising. So paying advertising, $550 by cash. 4, pay wages by check. And our next one is received commission of $250 by check. All right. So we have 5 transactions on the board. Bought stationery by cash, pay rent by check, pay advertising by cash, pay wages by check, receive commission by check. Now, in our previous lesson, we indicated that to determine the 2 accounts affected, you are going to ask yourself 2 questions, and in doing that, it will help you to determine identify the 2 accounts, and then we can move to the second rule, which determine where we record the accounts. All right. So this transaction says we bought stationery by check. question we'll ask ourselves is, what are we buying? Because the question is talking about bought. What are we buying? Answer, stationery. So that is the account. What are we using to buy the stationery? And the answer would be cash. Brilliant. Brilliant, students. All right. Now, second, pay rent by check. What are we paying for? Rent. What are we using to pay for the rent? Check. See, the two questions make it so easy to identify the accounts. Pay advertising by cash. What are we paying for? Advertising. What are we using to pay for it? Cash. Pay rent by check. What are we paying? Wages, rather. And what are we using to pay for it? Check. All right. Receive commission by check. What are we receiving? Commission. Says commission received and check. Now you recall in our previous lesson, we indicated that once you see the word check, it must be the bank account. So we don't open an account called check. It is really a bank account. And my good students will tell you, excellent students will tell you that because checks are drawn on accounts at the bank, so it is the bank account that you open. All right. So we have done objective 3. By interpreting a transaction, we're able to identify the two accounts affected in each of these 5 transactions. Our next objective to close our lesson is to record using the double entry principles. So we're going to erase here and then we are going to do the activity. All right, we're going to apply. So let's begin. By the way, our rule is, remember now the rule is accounts that receives you debit, accounts that gives you credit. Okay, remember that rule. All right, shall we go now? All right, so our first transaction says stationery, bought stationery by check. What are we receiving? We're receiving stationery. So let's write up the accounts first. Stationery account. And this side is the debit side and this side is the credit side. The other account would be cash. So we'll write cash in the middle here. And write the A/C, which is the symbol, DR for debit and CR for credit. So we remember that, huh? Okay. Now, so we're now going to be saying, indicating that the stationery, we are receiving stationery. Yes? Bought stationery by cash. What are we receiving? We're receiving stationery. If we're receiving stationery, the stationery account must be debited. By that we mean we're recording the information on this side, which is referred to as the debit side. Now I'm going to put a date in just for clarity, October 1, and we're going to have the name of the other account in the middle, which is cash. And the amount of money in the transaction was $400. So we write $400. And now, remember the trick about it is once you have identified the first correctly, then you can automatically determine what will happen with the second one. Because they work what? Opposite. Opposite. So if we debit in this account, then automatically we are going to credit in the cash account. So October 1st is going to be the name of the other account, which is stationery, and it is $400. Now the second transaction says that we pay rent by check. We pay for rent by check. So we are going to open a rent account. And we're also going to open a bank account. Okay. Now, what are we paying for? Rent. What are we using to pay for the rent? The check. So rent is receiving, that's the account receiving. So we're going to have October, let us say it October 2. And this is the name of the account. Other account is bank. And the amount of money is $10,000. If we debit in this account, then what are we going to do? Bright students, we are going to do what now? Crediting this, because once we know one, then we automatically know the other one is going to be on the opposite. So it's going to be October 2. Name of the other account is rent. Write it in the middle. The amount of money is $10,000. Right? There's something I'm going to introduce to you so you know. Because expenses are debit, yes, carry debit balance, then automatically once we are paying for it, that account is going to be debited. So once a transaction is saying that we're paying for any expenses, that account will be debited. So if we come to this one, which is also an expense, advertising, we'll open our advertising account, and for space I'm going to erase here. And I'm going to write advertising account. And because we are paying for advertising, we're paying it by cash, automatically advertising account is going to be debited. So it's going to be October 3. And we're paying it by cash, so cash is going to be in the middle here. The amount of money is going to be here, $550. Right? If we debit in this account, then the cash account will going to be credited. So we come here, October 3, advertising, $550. Pay wages, again, wages is a what? Expense, so we can open a wages account here. And we can now say that we are going to debit because wages is an expense. It's a expense. So October 4, the name of the other account is bank, because check is here, so it's going to be bank. And the amount of money is $700. And so if we debit here, the bank account will be credited. So we come to the bank and credit it, October 3. We're going to have what now? Wages. And the amount of money is $700. Our final transaction says receive commission $250 by check. Now, we are receiving money in relation by means of a commission. So in this case, we're receiving the check. So the check accounts that receives are debited. We're receiving the check. So it's going to be bank. Of course, once we see that, it's going to be bank. So bank is going to be debited. So we go October 5. Yes. And the name of the other account would have been commission received. And the amount of money is $250. If we debit in this account, then we're going to open a commission receive account and enter it. All right, let me see if I can let it hold right here. Commission receive account. So we debit, then this is going to be credited. October 5, bank, and the amount is $250. Okay, there you go. This is an example of dealing with the expenses, managing the expenses and revenues in your business. If there be any questions, please let us know. We'll be ever too willing to share with you and to explain further. Our interest in this session or in this class and these classes are really to help our students to understand and simplify some of the concepts so that you learn it very well. Thank you very much for being here with us at Kings and Queens Accounting Class. God bless you.